All right, welcome to this explainer. Today, I'm putting on my equity research analyst hat to totally tear down the financial and clinical data behind Annexon Incorporated, trading under the ticker ANNX. We're going to look under the hood of this clinical stage biopharmaceutical company and investigate a truly fascinating anomaly in the market. So grab your investigative journalist hats because we are digging deep into the SEC filings, the clinical trial data, and the institutional money flows to separate the hype from the hard data. Let's get into it. Now, before we get to the good stuff, let's start with our mandatory reality check. I am here to look at the data completely objectively, so please read this disclaimer carefully before we proceed. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Okay, let's dive into this central mystery because the gap between human optimism and algorithmic caution on this stock is absolutely fascinating. Seriously, when you look at Annexon, you are staring at a massive divergence in market sentiment. On one hand, you've got human analysts looking at the clinical pipeline and seeing a total goldmine. But on the other hand, algorithmic models are looking at the exact same balance sheet and practically blaring an alarm. Our goal today is to figure out exactly which side is right.
Section 1. The Great Disconnect. Wall Street Consensus versus Quant Reality. Let's build our bull versus bear balance sheet, starting with how the street views Annexon right now. On one side of the ring, you have 10 Wall Street analysts covering the stock. 8 of them have issued a buy rating, projecting a median 12-month price target of $12. To put that into perspective, that implies a massive 137% upside from recent closing prices. But on the other side, Ticker Nerd's systematic quantitative model, which, by the way, screens roughly 4,600 U.S. stocks, ranks Annexon at just 37 out of 100. That puts it squarely in the bottom half of the entire market. And when you look closely at their factor breakdown, its quality score sits at a dismal 25 out of 100, which basically indicates incredibly thin cash generation and unreliable profits. So the street sees massive upside, but the math? The math sees major risk.
Now, what's really interesting here is that despite those glaring quant warnings, the stock's momentum has vastly outperformed the broader market. Over a trailing 12-month period, Annexon returned an incredible 118.6% compared to the S&P 500's 19.6%. Ticker Nerd's model actually caught this, giving the stock a pretty high momentum factor score of 71. So the market is clearly aggressively bidding this stock up. But why?
Section 2. Clinical catalysts, the bull case, and the green flags.
To really understand that crazy momentum, we have to look at the green flags buried in Annexon's clinical pipeline. You see, the company has 3 massive binary clinical catalysts stacked up at the end of 2026 that could literally define its future. Annexon specializes in C1q-targeted immunotherapies. Basically, they're aiming to stop neuroinflammation right at its source. It acts sort of like a molecular off-switch. In the fall of 2026, they expect proof-of-concept data for ANNX 1502, an oral small molecule for autoimmune conditions. But the real heavy hitters arrive in Q4. They plan to submit a biologics license application, or BLA, to the FDA for tanruprubart in Guillain-Barré syndrome. That's a devastating disease with 0 approved disease-modifying therapies. Plus, also in Q4, they expect month 15 data for their geographic atrophy drug, vonaprument.
So, the absolutely crucial point here is their recent strategic shift in the Archer 2 trial for geographic atrophy. They've expanded this phase 3 program by adding a month 24 primary endpoint to complement the existing month 15 data. What does this actually mean in plain English? Well, it's a dual primary endpoint strategy. It effectively doubles their chances for a robust regulatory label by allowing the trial to show success in predicting against vision loss at either time point. It's a highly strategic, really smart move to capture long-term treatment effects.
Section 3. The institutional money trail, following the smart money.
You know, Wall Street analysts aren't just issuing these buy ratings in a vacuum. This chart brilliantly illustrates the conviction of the smart money. Just look at this. Over the last 12 months, we've seen over 100 institutional buyers pour nearly $320 million in Annexon. Compare that to the institutional outflows, which sit at a mere $18.8 million from just 30 sellers. Heavy hitters like BlackRock, State Street, and Red Mile Group have been aggressively accumulating shares. When institutions are buying at a 17-to-1 ratio compared to selling, it tells you for sure that they're positioning themselves for a positive outcome in those upcoming clinical catalysts.
Section 4. Financial reality, the bear case and quant red flags.
But as a skeptical investigator of financial statements, I've got to show you exactly why the algorithmic models are flashing red right now. Clinical stage biotechs burn cash, and Annexon is certainly no exception. Looking at their Q 2026 financials, their net loss widened to over $55 million for the quarter. And this was primarily driven by a massive $46.6 million in research and development expenses. Running global, late-stage registrational trials like Archer 2 is just incredibly expensive. And because they don't actually have an approved product on the market yet, their revenue is literally zero.
The media often ignores this kind of stuff because, let's face it, it's too complex for a quick soundbite. But this deep negative free cash flow conversion is exactly why the quantitative quality score sits at that dismal 25 out of 100. Over the trailing 12 months, Annexon had a negative free cash flow of $183.2 million. Their return on equity is deeply negative at minus 105.3%, and their operating margins are, of course, zero. Algorithms look at this cash burn profile and penalize the stock heavily, classifying the whole business as highly speculative.
Section 5, the synthesis, cash runway, and the economic moat.
So, we've got heavy cash burn on one side and potential blockbuster FDA approvals on the other. How does a company actually survive that kind of cash burn long enough to reach the market? Well, this right here is the ultimate green flag bridging the gap. $200 million. Annexon recently secured a strategic credit facility with Oxford Finance for up to $200 million, drawing an initial $50 million at closing. When you combine this non-dilutive capital with their existing reserves of over $209 million in cash and short-term investments, it extends Annexon's operating runway safely into 2028. This is huge. It means they are fully funded to get through all of their late 2026 data readouts and regulatory submissions without being forced to issue new stock at a discount just to keep the lights on.
So here is our final verdict. Annexon is building an economic moat based on intangible assets, specifically their first-mover advantage and patents in upstream C1q-targeted immunotherapies. And this moat is expanding, aided by regulatory boosts like the FDA Fast Track and European Prime designations, which expedite the whole review process. Because their cash runway is now officially secured into 2028, they actually have the breathing room to realize this moat if the Q4 data delivers. The stock is arguably fairly valued right now relative to the immense clinical risk, but make no mistake, this is a highly binary play. If that Q4 data delivers, the upside is massive, but if it fails, those quant warnings are going to be completely validated.
So what does this all mean? The quantitative models are pointing one way, flashing serious warning signs about cash burn and unprofitability, but the hidden clinical catalysts and institutional money flows suggest a potential storm of positive momentum is brewing right beneath the surface. So which side are you on? The algorithm or the clinical data? I hope this explainer helped you weigh the hype against the hard data. But remember, the final decision always rests with you. Do your own homework, read the filings, and invest wisely.